Hi, Taiga. How's it
Hey,
going?
good man. Thanks for having me. How is everything for your side?
Excellent as well. All right, let's jump straight into the questions. So maybe give us an intro to revenue financing and also like your type of product.
Sure. Like revenue-based financing is a way that companies can raise capital by pledging a percentage of future ongoing revenues in exchange for money invested. So if you are an e-commerce company or SaaS business, your future revenues are very predictable, let's say, so that by that prediction, some of the revenue-based financing companies are offering you uh, a small discounted price for your future contracts. In our case, we are not doing it for us. We are trying to focus on getting as much as early stage startups and small businesses into the platform. So we are not taking a, let's say, percentage of the revenue. We are giving you an ability to control your cash flow. So whatever spendings that you're gonna do with your Debite card, you can use it for it like a regular credit card. You can pay your Google Ads, Meta Ads, AWS, whatever you want to do, and pay us back at the end of the month. But once you realize that there's a huge upfront cost, maybe a I don't know annual payment of a software tool or a tax payment or anything related with your inventory, you can pay with your card and then take it like turn it into an installment. That means you can split the cost up to 12 months, which is basically giving you an ability to control your own cash flow. You don't need to give your percentage of your revenue, which is relatively low when you're having a marketplace or any other type of business, so that you can choose to pay in 6 months, 9 months, 12 months, or 3 months. So that's what we are doing right now.
Got it. So it's basically like an Amex for corporates, but then you're a bit more flexible on the duration on the payback.
Exactly. It's like it's all about managing the cash flow, right? Like you can build a great company, you can have like great profits, but if you cannot manage your cash flow, you're gonna suffer. So we are trying to solve that problem by tapping into your OPEX line in your income statement. Now, like everyday spendings or like any other spending that you can do with an expense management solution. One, we are helping you with the credit card, and second, we are giving you an ability to spread the cost. So that is actually helping you to have a better cash flow, survive, extend your runway without committing to a future percentage of your revenue. Because with revenue-based financing offers, if you're growing fast, your APR going up as well because you need to pay faster. That's what I like. If you're focusing on the growth companies, they need to be able to control their cash flow.
Got it. Got it. And what are the typical clients of yours then, as opposed to maybe, some of your competitors or other revenue-based financing, let's say, solutions?
Yeah, our typical like we have let's say three type of customers. One is a traditional SME. We can say moderate growth, moderate cash, money making SMEs. So we are helping them to like they're actually using the installment product a lot because it's actually solving a big problem. The other 40% is VC backed or like angel backed high growth startups, but up until Series B. So we cannot help the Series B and plus companies, which revenue-based financing companies are mostly focusing on. Because if you're gonna get a big chunk of money, you need to do at least $100,000 MRR. We are not focusing on that. Our minimum eligibility criteria is £5,000 per month, so that from 5,000 to 100,000 we can cover that area. And the whole idea is while they are growing, our customers are growing from 10,000 to 100,000. We need to be able to grow with them and offer different products as well. But it's all about understanding the dynamics and the data of our customers, what they need, how we can solve the problem. One quick example is the more that we go in and understand the data of our customers, we launched a new product last month called Debite Pay. As you can imagine, lots of merchants and customers doesn't accept credit cards. They don't have to, but we build up a new product that is allowing you to do bank transfers from your existing credit line. So that is a big game changer because now we can easily cover the biggest chunk of a company's expense, which is the payroll, for example. So now we are in a position that becoming like 75% of our customers' primary spending channel. That's what we are focusing on. If we can go deep dive in, we can understand more and we can actually help you to solve the problems that you have. And the last
Makes sense.
20% of our customers are just like experimenting stuff. There are like consultants, small marketing agencies, one-man shops. Like that's what we are trying to understand whether we can help them in the near future or like how does it affect like that different type of companies are affecting the underwriting model.
So basically, a lot of bootstrap companies use your service, basically.
Exactly. Imagine that you are doing like 4K, 5K profit per month, but it's all about like collecting that money and having a good cash flow because like yeah, at the bottom line you can be profitable, but if you cannot collect your receivables and you're paying before all your annual cost of your software, I don't know, tax, everything, it's gonna affect you in a very bad way. We are trying to solve that immediate problem because like you can get the card in 24 hours, and then after that, there is no process for you to basically turn into an installment of any other transaction that you have. It takes like 3 seconds. So that's why it's a very easy to use product. Whatever you spend, you are paying that back. So it's relatively more efficient for startups as well.
Do you see some of your clients use maybe like a bank debt facility, a revenue financing facility, and then also your card? Or maybe it's more like, okay, your card and then maybe also a bank facility.
They are trying to consolidate all those loans or like other credit cards into one single platform. That's what we see. They're starting with us when they have another revenue-based financing offer as well. But once they realize that this process is smoother, easier, faster, we realize that they stop using other services. It's not only revenue-based financing; they stop using their own bank account as well because like we are stealing the interchange fee of big traditional banks now. They don't use the debit card of Barclays or they don't use the debit card of NetWest. They just started to use Debite card. So they both like all of them can both coexist in an environment, but at the end, the more data that you give to us, the better let's say offer you're gonna get. Your I don't know interest rate is gonna go down, your tenor is gonna go up. The more you pay us back, we are like building that trust and data relationship with you.
Okay, cool, interesting. And then the other thing is, last 2 years, a lot of the alternative financing solution, non-dilutive financing solutions, raised a lot of money on the market. For, let's say, a client, be it a SaaS company or a consulting company or whatever, does it actually make a difference if they raise money or if they take money from somebody who raised 200 or 300 million, or maybe a player, for example, you obviously one of the new entrants in the market, you raised a bit less. Does it actually matter how much you guys raised?
I don't think it's gonna matter because the trust issue. If you are getting a like a yield product, yeah, like the company that is giving you yield should be a very sustainable one. Maybe you need to have like a couple of $10 million in the bank, so it's gonna help you to build trust. But in the revenue-based financing case, in our own case, like the built-in installment product, uh, you don't have to trust anyone because like those companies are lending you the money. So in the worst case, if those companies goes down, you're not gonna lose anything because you're not using your own money, you're using their money. So I think that's why the good thing that raising tons of capital is helping you to reduce cost of the capital which they are borrowing as well. So if you have tons of cash in your equity side, you can borrow money in a more cheaper way. So that is going to help you to acquire more customers, have a better retention because the cost of capital should go down. But the more analyze that I do, I see that the cost of the capital for startups doesn't change. Like the revenue
Yeah.
of revenue-based financing companies can go up, but like I don't see the there's a positive correlation between
Yeah.
big raise versus like a, let's say, lower interest rate or lower fixed rate of a revenue based financing.
Mhm, mhm. So what
Obviously, yeah, yeah.
what would you think is the main driver when somebody wants to pick a provider, for example?
Um, I think like it's all about what stage you are and what type of business you are. So if you are doing more than 100K MRR, and if you're an e-commerce or SaaS company, I think revenue-based financing is a good offer for you. And if you have a big chunks of, I don't know, cost that coming up in the near future, for example, if you're a D2C company, if you're gonna get lots of fabrics, you need to have like 400,000 pounds for the next 3 months, and then your cash flow is going to cover all of them. Go ahead and do it. But if you're like doing 30K, 40K per month, uh, one, you won't be able to get anything from those big guys. And second, you don't need to have 500K. It's a big liability in this environment. So we are in a position that capping the installment at 50K, so that we are trying to show you that 50K can help you. And if you are doing like 20K per month, yes, it can really help you. If you're doing 200K per month, 50K is not going to help you to do anything. So it's all about what stage you are and what type of business you are. I'm remembering from my previous company, I was like looking for other options, other financing options. I go into one revenue-based financing offer. It was a marketplace. And my previous company was a marketplace. I couldn't get anything because my take rate was very small. So when you take the revenue from that take rate, I was doing money. I was doing a business for a revenue-based financing company. So if you're a marketplace, it's not gonna work for you. But if a
Mhm,
SaaS, future predictable companies could go to
mhm,
revenue-based financing options, and we can coexist with them. If you're gonna get 500K from, I don't know, any other revenue-based financing offer, you can still get a credit card from us. You don't have to use the installment option. You can cover day-to-day expenses with Debite card, and when you're buying a big inventory purchase, you can go and do the revenue-based financing offer.
mhm, mhm, mhm. Makes sense. Makes sense. And in terms of, again, like going back to the notion that so many people raise so much money in this space, and then we heard some rumors that some people shut down, etc. Do you see more players shutting down over time?
Yeah, obviously, like it's all about related with their customers as well. We're gonna see lots of small business, medium businesses are gonna collapse in this environment, and they don't have a personal guarantee. They don't have a leverage to use. So that's why the the market in 2021 is completely different in 2022 and 2023. So that's
Mhm,
why we're gonna see lots of problems on that field as well.
mhm. With your product, do you take a guarantee or is there some charge? No.
No, no, no. Whatever you spend,
Mhm,
once you start to do installments, we get a interest fee. That's why our limits are relatively smaller, and we are focusing on smaller companies. But like 2 years later, we should be able to offer them a revenue-based financing offer as well. If you're gonna keep on working with the same companies, because hopefully they're gonna grow, they're gonna spend more, and they're gonna need more money. So that's what we should do. That's the whole focus, because when nobody is focusing on that small businesses, we are there for them, and we are trying to say that, yeah, that the acquisition cost is relatively cheap because no one is targeting them. But if they're going to churn 2 years later, when we think that they're going to be the most valuable, it's not going to happen. So we need to be
mhm.
there. We need to offer different products.
Okay, so that's your product roadmap. So would you then say that ultimately maybe you also one day want to become a bank as well? Like some other banks are also offering revenue-based financing right now as well.
Yeah, I think the goal is to become founders wingman. That's what we call. If they need a yield product, we're gonna be there. If they are looking for a
Mhm,
revenue-based financing offer, we're gonna be there. Expense management solution there. But it's like step by step. This is like
mhm,
it's gonna be slowly, slowly, and then suddenly. That's what I believe.
mhm, mhm, mhm. Cool. And in terms of like, your personal or your business number one challenge right now, what is it?
uh, like it's a very good time for, let's say, building a lending business, because in from 2016 to 2021, you don't see lots of, let's say, default actions. You don't see how they are reacting, how what's the data is evolving. But now we are like seeing lots of stuff on default, non-payments, late payments. So it's actually helping us to build a strong model, and we are counting on going in the next 10 to 15 years with this data model that we are building. So I think the challenge is finding customers are easy, but finding customers who are going to pay you back is hard. So we are trying to understand what is the common pattern of a successful customer. That's the biggest challenge. If you can find the common pattern, then you can build something on top of it. Now we don't know it because we have like 80, 90 customers. So that's why we're trying to understand whether we are doing the right thing by going a bit slower than what we are expecting, or we need to go full force. Like these are the things that we are experimenting right now.
Makes sense. And then I guess to conclude, what would you recommend to a founder in this environment right now?
Yeah, I think that in this environment, you need to understand what's going on in your company. Like you need to see the pain points, what is leaking, what is coming in a good way, what can you change immediately to have a better cash flow, to have a better financial situation. In order to do that, you need to have a good measurement tool. Like you need to see your company's like a big picture, the health of your company, and then you need to have the right tools to solve those pain points. Or if you can like find what's going on, define the problem and solve the problem with the other tools, then is one thing missing is the resilience. If you have resilient enough, you can survive from this environment in the next 2 or 3 years, and then when things are becoming better, you're gonna go faster. This is what we expected, what experienced before. I'm from Turkey. We were having lots of crisis, political, economical wars, everything. So that's what I understand from my previous experience. If we can survive and be resilient, everything is gonna go back.
Sounds good. Sounds good. And then how can people reach you, find out about you?
I think easiest way is LinkedIn, linkedin.com/Taiga. They can always add me, ask questions, and of course, if they need any financing options, Debite.io is the answer.
Awesome. Sounds good. Thanks so much for your
Alexei,
time.
thank you so much for having me. It's a pleasure.